Could artificial intelligence spell disaster for the U.S. financial system? A question that's been on the mind of U.S. Treasury Secretary Janet Yellen. Yellen, along with top U.S. regulators, has been paying close attention to the systemic risks that advanced technologies such as AI could pose to the stability of the U.S. financial system. These concerns were brought to light during a recent Financial Stability Oversight Council meeting, a council formed after the financial crisis of 2008 to address systemic risks. The council, which includes the heads of key financial regulatory bodies like the Federal Reserve and the Securities and Exchange Commission, identified the use of AI in financial services as a key vulnerability. While it's true that AI can bring increased efficiency to the sector, Yellen emphasized the importance of applying existing principles and rules for risk management to these AI innovations. Wall Street has been quick to adopt AI, with data engineers and quantitative analysts being enlisted to harness the power of this technology. But with this integration comes potential risks, and these risks have not gone unnoticed. Senior regulators, such as SEC Chair Gary Gensler and Michael Barr from the Fed, have voiced their concerns about AI's potential to introduce or amplify risks at financial institutions. One such risk is the potential for discriminatory bias in lending practices, something that becomes even more concerning when dealing with AI systems that function as black boxes, producing outputs that are difficult to explain and could potentially hide biased or inaccurate results. Despite recognizing these risks, the FSOC's annual report didn't offer specific regulatory proposals. Instead, it provided general guidance to member agencies and financial firms, advising them to build expertise and capacity to monitor AI innovation and usage, and identify emerging risks. In conclusion, as Wall Street continues to integrate AI into its operations, the need for regulatory oversight becomes increasingly apparent. This is a story that is still unfolding, and it's one that we'll keep a close eye on, as it could very well shape the future of the U.S. financial system. As AI's influence in the financial sector grows, so does the concern of senior regulators like SEC Chair Gary Gensler and the Fed's Michael Barr. Indeed, Wall Street has increasingly integrated AI into its operations, bringing on board data engineers and quantitative analysts. Yet this trend has sparked alarms as potential dangers emerge from the shadows of these advanced technologies. One of the most significant concerns raised by regulators is the potential for AI to introduce or amplify risks at financial institutions. AI's ability to apply discriminatory bias in lending practices stands as a particularly unsettling possibility. Picture a world where an algorithm decides who gets a home loan or a small business loan. This might sound efficient, but what if these algorithms are biased, favoring certain demographics over others? This concern escalates when we consider AI systems that function as black boxes, where the outputs are hard to explain, potentially masking biased or inaccurate results. These concerns have not fallen on deaf ears. The Financial Stability Oversight Council, a body established to address systemic risks, has taken note. Although the Council's annual report did not offer specific regulatory proposals, it did provide general guidance to member agencies and financial firms. The advice: build expertise and capacity to monitor AI innovation and usage, and identify emerging risks. It's clear that the FSOC recognizes the potential benefits of AI, from increased efficiency to superior data analysis. But it also sees the need to apply existing principles and rules for risk management to these new innovations. So, where does this leave us? As we stand on the precipice of an AI-driven financial future, it's clear that we can't afford to ignore the potential risks. We must strike a balance, harnessing the power of AI while ensuring it doesn't undermine our financial stability. As Treasury Secretary Janet Yellen rightly points out, while financial firms are broadly sound, regulators must remain vigilant. While AI offers many potential benefits, unchecked, it could pose significant risks to our financial stability. As we reflect on the events of 2023, including notable bank failures, it's clear that while financial firms are broadly sound, regulators must remain vigilant. In the face of an AI-driven financial landscape, this vigilance is more critical than ever. U.S. Treasury Secretary Janet Yellen has echoed this sentiment, praising the quick actions of Financial Stability Oversight Council member agencies in mitigating risks and maintaining confidence during these turbulent times. Yet, she also acknowledges that vulnerabilities persist. The FSOC report provides a detailed review of recent banking incidents, drawing attention to the lessons learned. Poor management, high exposure to interest rates, and uninsured deposits were among the primary culprits. The unprecedented speed of bank runs, amplified by digital banking and social media, further underscored the need for robust regulatory oversight. As we move forward in this AI-driven world, it's clear that education is key. Consider bolstering your knowledge with an online MBA from BHSEU, a top-level, low-cost option for those seeking to navigate the complex landscape of modern finance.